Okay, we are going to finish up problem number 1. That's what this video is. Maybe problem 4 in this video, I'm not sure, but anyway, at least number 1. All right, so we already started it, but it's a statement of cash flow problem, and Marion Company is 80% owned by Lang. They purchased it for $680, blah, blah, blah. We have all this stuff, and we'd already done all this, okay? So here's the top part. They end up having equipment of $50,000 needs adjusting, Goodwill of $150. And I put this in here because, you know, they're amortizing it at $10,000 a year for the amortization. So we need to know that information. Then they gave us the balance sheet, all right? And I had copied it down here. There is the worksheet. I don't really like using the worksheet. You're more than welcome to if you want to, but this is how I prefer to do it. Let me, oh, sorry. Oh. Helping Kendall out with intermediate homework. I was trying to make this a little bigger. Okay, so we had, I copied the balance sheet over. Let me make these bigger. I don't know why that's so small. And that's what this is, okay? All right. So then after we copied it over, we went through and we did the change, okay? So they gave us this information, and I just subtracted the end of the period minus the beginning of the period. Or this is actually the end of last period, however you want to look at it. But we need to find the changes in the accounts because we're going to use these numbers to figure out what caused the change in cash, okay? We're not going to actually use this number much at all, but we need all these other ones for sure. All right, then they gave us, let me just minimize that puppy. On the next page over here, they gave us additional information. All right, and that's where these notes came from over here. So Marion purchases equipment for $70,000. So that's $70,000 of the $420 here. They issued $350 of long-term bonds and later used the proceeds to purchase a new building. All right, so they got cash of $350 and then they spent the $350 on a building. So the 70 plus the $350, that's the $420,000 change in plant, property, and equipment. They didn't sell any equipment, so the whole change in accumulated depreciation is actually depreciation expense, okay? Then in Part C, they purchased 30% of the outstanding stock of Charles Corp for $230,000. It's an influential investment. Charles stockholder equity is $700,000 on the day of the purchase. Any excess cost is attributed to equipment with a 10-year life. Charles reports net income of $80,000 in 2016 and pays dividends of $25,000. Okay, so in this investment, we have a $244,500 increase. All right, so it's the actual investment of $230,000. It's increasing by that amount, plus equity income, let's see what I wrote there, plus an increase of $14,500 in equity income. All right, that $14,500 in equity income comes from Charles had, what did Charles have? Charles had net income of $80,000. We own 30% of it. So $80,000, that's what this little thing over here is, okay? That's how we got to the $14,500 down here. All right, they had equity income of, they had net income of $80,000. We own 30% of it. So 80,000 times 0.3 is 24,000. All right, then they paid a dividend of 25,000. All right, so we got 30% of that. right, and our investment went down by that amount. All right, and we don't need to like actually consolidate and all that, but it has that any excess cost is attributed to equipment. All right, so that's this right here. All right, we paid $230,000. Our share that we purchased was $210,000. All right, that's the $700,000 of their equity times our 30% investment. All right, that's what that is right there. And so if you subtract, that is $20,000 excess, and it was all attributable to equipment that's amortized over 10 years, and that's $2,000 a year. All right, so we also need to subtract that out, and that's where the 14.5 comes from. Okay. All right. Goodwill, there's no change. Accounts payable, the accounts payable was just decreased. So we'll talk about that when we do the statement of cash flows. All right, the bond payable, that came from the bond issue. I'm just going to put part B here. Okay, or note B. We'll put note B. All right, and the non-controlling interest, that's non-controlling interest is $15,000, and then Lang paid $100,000 in dividends. 20% of that goes to this, so this is actually going to be, you know what, I'm going to move this right here because it's in my way. No, I don't want to move that there. I'm going to move it down here. All right, and this 2,000 is what went up here. Okay, so my non-controlling interest changed. They got the non-controlling interest in consolidated income is $15,000, but then they also got, or what needs to come out of there is dividends. Let me see. I don't know. I'll figure it out in a minute. I don't know if you really need to know, actually. And then our change in retained earnings, we'll look at that when we do the statement of cash flows. Okay, so now we need to do our statement of cash flows. And did they give us a place over here for it? I'm just going to type it out. I'm going to type it out over here. Don't know why everything is a 9 font. I can't see anything. Of course, it should have the whole heading and whatnot. I'm not going to worry about all that stuff at the top. All right, so our first section is cash flows from operations or operating activities. Doesn't really matter to me. All right, we're doing the indirect method, so it starts with net income. So we have to figure out our net income. All right, our net income, we had, they actually told us. It's the net income for the whole thing. All right, so it's going to be, if we look at the book, where'd the book go? controlling share is $262. Non-controlling interest is $15,000. All right, so it's going to be those two added together. $262 plus $15,000. All right, is our net income. All right, and that's from Part D. All right, so we have adjustments. All right, first thing we're going to do is add back depreciation expense. And just the normal depreciation expense, and that's this number right here, the 206. We didn't have to do anything special for it this time. Sometimes if they sell equipment, you have to worry about it, but that's where that came from. All right, then we just go down the line here. We had an increase in inventory. All right, that means we bought some inventory that was not reflected in cost of goods sold. So we need to subtract that out. All right, then accounts receivable increased. All right, that means we did not collect money. So we also need to subtract that out. All right, that's it for our current assets. Then we need to go down to our current liabilities. All right, accounts payable decreased, which means that we paid for something. Cash went out the door. We paid stuff. Right? Did it not? Actually, it increased. It looks funny to me because they have it as credits. Okay, so but if you look at it, it actually increased. All right, so if accounts payable increased, that means we didn't pay for something. So $83,000. We add that cash back. Okay, then we also have another non-cash thing that we need to worry about. And it's the stuff from Charles, okay? If you recall, this right here, this $14,500 from Charles, we would have recorded in general, okay? We would have had an investment. We would increase the investment in Charles. And we would have recorded investment income. For $14,500. All right, this is a non-cash transaction. We didn't actually, get all that cash. All right, so I need to take this back out. All right, so this is equity income from Charles. Now, where is my screencast? I need to pause. Not recording that. Okay, so it's equity income from Charles in excess of dividends, which is what we did because we have we subtracted out dividends right here. All right, so we didn't actually get all that in cash, so we subtract that back out. Okay, I think that's it for that one. So then you sum this up. And this is net cash provided by operations. Okay, then we need to do cash flow from investing. All right, so let's look at the book real fast. In part B, part A, we bought equipment, and in part B, we bought a building. So that's going to go in the investing section. All right, cash paid for equipment. That was $70,000. We had cash paid for building. That was minus $350,000. Okay, and then we also made an investment in Charles. All right, and the investment amount was the $230,000. Okay, so cash paid for Charles. Say investment in Charles. And that was when I said 230. And that's it for that one. Easy peasy. Net cash used by investments. Investing activities. Cash flow from financing is next. All right, so for the building, remember we issued a bond, we got the cash, then we bought the building. So we need we got cash from bonds. That was $350,000. All right, and then let's go back and look at the, all right, Lang is the owner, so we paid dividends of $100,000. And then Marion paid $15,000. We don't count all of that, but we do have to count the 20% that went to outsiders because we only own the company 80%. All right, so then we have cash paid for Lang dividends. That all went to outsiders. So that was $100,000. And then cash paid to NCI dividends. And that is, they paid $15,000 in dividends and 20% went to outsiders. Oh, I need a money sign for that. Probably doesn't all need to have a dollar sign, but I don't want to mess with it. All right, so that's net cash. Probably provided, right? By financing. Activities. I'm going to sum up those three. Okay, so then you add these three up. And we have increase in cash. Now we're going to have a decrease in cash. Oh, you know what? I messed up. This number right here, this is, I think this is just this right here. And then I have to add net income plus this. There we go. That looks better. Sorry about that. Okay, so then these three add up. And that gives us, let me add them up before I put what it is, because I don't know what it is. So in financing, investing, and operating. So those three add up. What do I have? Oh, I put the parenthesis. We don't need that. Okay, so plus. So this is net cash, net increase in cash. All right, and that number is these guys. Blue, 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 and blue. All right, those add up to that. All right, so then you put cash at 1/1, whatever the year is. Let me know what year it is. 2016. Cash at 1/1/2016, and that was 16,000. And then you add those two together, and that should give you cash at 12/31/2016. And that should tie to that, and it does. So this number is this number. I'm not going to like that color combo, but oh well. Actually, I'm just going to make all these the same color. Okay, and that is it for the cash flow. I was going to try to do both 1 and 4, but this is already a long video, so I'm going to stop at this one and then make a new video for homework number 4. If I can find my